There is a new buy signal emerging in the stock market that is not only rare, but actually extremely effective at predicting the bottom of most bear markets, north of 90%. Now trust me folks, I know exactly what you're thinking. How on earth can we believe a technical signal like this when we have an economic recession looming ahead of us, inflation that is falling, and a Fed that still does not know what to do with its interest rate hikes? And I know exactly why that is the case. Because despite the more than 15% rally we have seen in the Nasdaq since the start of the year, markets are still selling off some of the more riskier stocks in the market that happen to be more focused towards retail investors like us. But as much as I hate this phrase, folks, I do think this time could be different. In this video, I want to explain why that would be the case and also give some of the reasons why small cap stocks have been getting destroyed for the past month and how this has occurred over the past few bear markets. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I want to explain what this rare buy signal actually is, and I want to give all the credit to zerohedge.com for this information. Essentially, this new buy signal is a technical signal around what the S&P 500's closing price has been compounded over the last 35 days. And as you can see in pink, every single time this buy signal has occurred without fault, markets have rallied over the next 12 months on average anywhere between 10 to 30%, particularly for the S&P 500. Now trust me when I say this does not mean that your portfolio is going to automatically recover over the next 12 months. This is solely for the S&P 500, which are the 500 biggest companies in the US. Whether you're investing in foreign stocks in China, small caps, unprofitable companies, or the EV sector, you are going to get different results for each. And the best part about this indicator is that not only does it signal buy signals, but it also signals sell signals. And as you can see over the past 25 years, during both the dot-com crash and the 2008 crash, we saw this signal trigger right before more than 30% drawdowns in the S&P 500. Whether or not this is an accurate justification for it going forward, I'll let you decide for yourself. All I can say is that focusing on technical only indicators like the Coppock signal in most cases will give you a clearer picture than focusing on the mess of the macroeconomic situation. Because guess what folks, the macroeconomic data is what drives the Fed and their interest rate hikes, which in turn drives the S&P 500 one-year estimates from most analysts on Wall Street. And as you can clearly see, there is little correlation in what the S&P 500 does with what is the forecast from most strategists. As a matter of fact, the blue line, which are the forecasts, tend to lag what the S&P 500 does by a significant margin. You can clearly see that when the S&P 500 goes up and hits a new all-time high, these estimates skyrocket. And all of a sudden, when the S&P 500 starts going down like it did last year, these estimates start falling with, let's say, a 2 to 3 month lag. So focusing on what the analysts are saying, what they're predicting, and how deep this upcoming recession is going to be based on these forecasts is a fool's errand. And this, unfortunately, is something many retail investors fail to understand, which is that investing in the long term, whether that be large cap stocks or small cap unprofitable growth stocks, is a game of fundamentals more than macroeconomics. In the short term as a trader, sure, the macroeconomic data for CPI, jobless claims will have an effect on the price action, but in the long term, it has a minimal effect on businesses. Which is why if you're making decisions on these short-term headwinds and tailwinds, you are making a grave mistake. And that is exactly why focusing on a technical only indicator like the Zweig thrust or the Coppock is typically an interesting and successful strategy for most traders and gives investors like us a sense of direction on what the market is thinking in the short term, even though, like I've said multiple times in the past, nothing is guaranteed. But obviously, folks, that is just one side of the story. Like I mentioned earlier on, small cap stocks are actually diverging from what the overall market is doing. And the reason why it affects me the most is because guess what? I do invest in a lot of small cap stocks. The majority of my portfolio has market caps under $10 billion. And right now, the S&P 500 is unfortunately weighted mostly towards the biggest of biggest companies, north of $500 billion. So as a result, we can't just look at what the S&P 500 is doing to get an accurate picture of what most retail investors are going to be experiencing over the next 12 months. And here's my solution to that problem. And that solution is the S&P 500 Biotech ETF, which, as you can see, over the past 12 months has been gravely underperforming what the actual index has been doing, particularly since the start of 2021. And why exactly does that matter? Well, because as somebody who invests in some unprofitable stocks, this is going to be a much more accurate representation than the S&P 500. Because as you can clearly see, since the start of 2021, this index peaked, whereas the S&P 500 still rallied until the start of 2022. And this index faced the biggest drawdown, north of 80% from peak all the way to the trough. Because guess what? The biotech industry is extremely risky, and most companies are burning cash like crazy. And because of that, this line in blue is going to be a much more accurate representation of how unprofitable growth stocks are generally performing in the market and how they perform relative to the S&P 500. Where the S&P 500 recently hit a new local high, this index instead made a new lower low. And for those wondering what exactly is causing this difference in performance, look no further than the jobless claims that we've seen come out since February. We're nowhere near the levels like we saw during the Great Financial Crisis or 2020, but we're almost up there. And this is scaring investors out of any company that has a negative free cash flow. Because for those that don't already know, when recession hits, earning estimates collapse, and that means you're going to get a better return from bonds. So why would you buy a risky stock that is potentially at the risk of going under or getting bought out at a very cheap price? This is unfortunately the number one reason why we're seeing this divergence, and this means that even if the S&P 500 starts to rally, small cap stocks might not recover nearly as fast. But before you get disheartened, I want you to know that this has happened in the past, and this is what the outcome has been. As you can see, the S&P 500 bottomed in March of 2009 and then rallied all the way up until April of 2010 after hitting new fresh highs. But the XBI Biotech ETF, also although bottomed at the same time in March of 2009, did not hit a new relative high until April of 2010, whereas the S&P 500 hit a new high all the way back in May of 2009. Does this seem familiar to you? Because this is exactly what is going on right now in markets, where the S&P 500 is rallying out of a bear cycle, yet small cap growth stocks are underperforming just for the short term. And as you can see, over the next few years, the XBI ETF did indeed follow what the S&P 500 was doing and rallied to fresh new all-time highs. Whether there's any merit to this correlation, I'll let you guys decide that for yourself. As usual, let me know your thoughts down in the comment section below, and whether or not you think this is a buying opportunity in the markets or we should rather just stay on the sidelines. I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.